thank you for the opportunity to talk about SPACs in general here and European Cleantech 1, ECT 1 in specifics. The objective of this presentation is to make you familiar with SPACs, and I've chosen an agenda about around 3 topics. I would like to start talking in general about SPACs, give you a little background, what they are good for. Secondly, I would like to focus on the Cleantech space, why we believe the Cleantech space is a really interesting space for a SPAC product. That's why we founded European Cleantech in summer last year. And thirdly, I would like to share with you what exactly we are looking for in a Cleantech business, how the process works of partnering with a SPAC from the entrepreneurs or shareholders' perspective, and what the key success factors are for all involved parties in a SPAC. And once we're done with that, we will have a discussion going on. Now, I've been informed that I should look at the watch in order to make sure that I don't run out of time. That stays at 20-minute quit, doesn't move, so I assume I have all the time I want. A special purpose acquisition company, or SPAC, is like so many things we see in general, in particular in the finance world, something that originates in the US and with a certain delay came into Europe. A SPAC is a very innovative financing vehicle that is now slowly finding some acceptance in Europe. Ultimately, it's a listed shell company that only has one objective: to find an operating business to which it basically transfers or hands over its listing, because many companies are interested in being listed, in having access to capital markets. So what you typically do is, and let's do that by talking, or let me describe that by talking about ECT1. You list a company. We listed ECT1 in October last year. We raised 115 million, 115 million euros from institutional public equity investors, and we, the sponsor team, now have 2 years' time to find a business combination target, to find a company that we're going to merge with, that we're going to acquire, and that's subsequently going to pick up our listing. If we don't succeed to achieve that in 2 years' time, our company will be liquidated, and all the IPO proceeds, the 115 million euros, which currently sit in a trust account, will be shed out to the investors again. So the interesting thing about a SPAC is it aligns in a unique way, or in a beautiful way, the interests of all involved parties. There are 3 parties. One party is the entrepreneur or the operating business we are looking for. They have an interest to access capital markets. A SPAC offers tremendous advantages over a conventional IPO. The second party is the institutional investors, our current shareholders. To them, it's a risk-free investment because all the money sits in a trust account. We earn some interest, which we can use to fund our expenses. Our expenses are limited. Our expenses are travel expenses. In the context of deal sourcing, our expenses will be due diligence expenses. The majority of those expenses is actually being funded by us, the sponsor team. We put 5 million on the table, which is fully at risk, to finance the IPO and to fund our expenses during this maximum 2-year lifetime. And thirdly, it also considers and aligns our interests, the interests of the sponsors. We don't put 5 million on the table just for fun. We want to make some money out of this. We only make money out of this once a business combination has been performed, and only if the share price then picks up post-business combination. If that happens, we can make a decent return or an attractive return. If that doesn't happen, we don't make any money. If this company is liquidated and the 115 million is being shed out to the investors again, our 5 million are gone. They are fully at risk. I said it's a concept which originated in the US and is still very exotic in Europe. I've done some research on this. I've put together some numbers. I quickly want to spend a minute or two. on SPACs and the history of SPACs. We currently have approximately or exactly 185 SPACs, which have been in existence, respectively, are still live since 2003. As you can see, there was a significant pickup from 2004 to 2007, actually into 2008 until the Lehman crisis. The majority of the SPACs being listed in the US. 170 of the 185 are US SPACs, only 15 in Europe. Currently we have 10 SPACs which are live, 7 in the US, 3 in Europe. Typically, or people who have been involved with SPACs over some time talk about an evolvement or development of SPACs. They talk about different generations. They refer to generation 1, which are the early entries or early movers, initial SPACs. These SPACs were characterized, for example, by only 85 to 90% of the IPO proceeds sitting in a trust account. So the sponsor team had 10 to 15% of the IPO proceeds as a kind of management fee if you were to compare it to private equity. Now in our case, that would be very convenient. That would mean we would have 10 to 15 million of the 115 million we could spend. We could pay ourselves salaries, etc., etc. This is no more the case. So the structure has changed. Right now in the post-Lehman SPACs or the Generation 3 SPACs, you have 100% of the IPO proceeds sitting in the trust account. Similarly, if you look at the sponsor promote, our incentivation, in the first 2 generations, frequently the sponsors were incentivized by getting a deal done, by identifying a company which then achieved the approval of the shareholder meeting. Thus, the listing was handed over, and with that transaction closed, the sponsors would get their shares in the deal. That's a very interesting model for sponsors. Now, we only get a certain part of our sponsor promote with the business combination being closed, which takes us out of the risk but doesn't see us earning any money yet. We only start earning money, and this is true for all Generation 3 SPACs, or most of them. We only start earning money if the then listed operating company actually achieves a share price increase of at least 10%. We have 2 thresholds, 10% and 20%. If that happens, the operating business shareholders are happy because they've seen a further value creation. The institutional shareholders, capital markets, are very happy because they've seen a value creation, and then we also start participating. Approximately 66 SPACs of the 175 which have ended their life cycle were actually liquidated. So it's not a safe bet that there will be a business combination. It depends pretty much on the sponsor team to identify the right company, which is capital markets compatible and which has an affinity to actually move to capital markets. Why Cleantech? I don't need to spend too much time about the prospects of Cleantech, and Cleantech being a high growth or phenomenal growth industry, which is at the same time sustainable. You are all aware of that. That's why you're here. That's what we've heard in other discussions. I don't want to focus anymore on that. But there is one aspect which, from our point of view, gives us a case for a SPAC. Cleantech businesses, and we just heard it about this Swedish company which is looking for money, Cleantech businesses still need a lot of money to finance their technological development, to finance their growth strategies, etc., etc. And during the past few years, as you can see on this slide, it has been very difficult, for example, to raise equity. If we look at the global IPO volumes, they have dropped dramatically by more than 50% in volume, number of IPO deals, and similarly in the value of the IPO deals. And more importantly, if you look at the Cleantech IPO deals of last year, there were approximately 93 deals, if I'm informed correctly. 70% of those were in China. So the vast majority in China, enormous difficulties for European companies in particular to raise equity. The same is true for debt. Now here's a graph by Dealogic in regard to project financing, but that is also true for general debt financing. Just like on the equity side, a significant drop in the volume or in the value as in the volume of deals, as in the number of deals. And that's where we believe there's really a case for a SPAC to offer a financing solution. We've got 115 million sitting on our balance sheet, waiting to be invested in just one business. We're not going to buy a portfolio like private equity companies typically do. We're going to identify one company we're going to work with. This company is going to get the 115 million euros. The 115 can be used for basically two different things. One is it can be a pure cash injection to finance growth. Secondly, it can be used to finance a partial exit of shareholders, or it can be a mixture. So we are very flexible in what we can do. We have all the opportunities, and one very distinct differentiation to the typical private equity investor, we are not interested in a majority stake. SPACs typically buy minority stakes, typically between 25 and 50%. That is very interesting for the incumbent management, which is frequently identical with the shareholders, if we're looking at privately held companies, because they remain in the driver's seat. Not like in the private equity environment, where the private equity company basically takes over and management is reduced to executing the strategy, but management, shareholders stay in the driver's seat. There's other reasons why a SPAC is really interesting to companies, to operating companies. It's a very fast access to capital markets. We always talk about fast-track IPO. A typical IPO takes between 6 and 9 months. Partnering with a SPAC, partnering with ECT1, history tells us, or statistics tells us, that it typically takes between 12 and 16 weeks to actually take the company to public markets. We need to go through some due diligence, we need to negotiate an SPA with you, we need to have a shareholder meeting, but once that's done, it's a done deal, and you're listed just like that. Secondly, a SPAC takes out the risk that is inherent in a conventional IPO. If you look at the recent press and the effects of Fukushima, the various IPOs in Germany, in Europe, on a global scale, being postponed or being pulled, this doesn't happen with a SPAC. The listing is already there. We had the risk of not IPOing the company in October last year. The listing is available. So it's quasi a riskless IPO for an operating business. Thirdly, what we also offer, in addition to that, is a sponsor team which, from our point of view, brings important know-how and experience to the table, which should allow a very smooth transition to being a public company. By coincidence, and that really is a coincidence, I'm partnering with two managing partners of the company Holger Schmitz just presented. Two managing partners of Ventis. Holger Schmitz made a case that 50% of their investments have been in the Cleantech area. Ventis is without doubt one of the, if not the most experienced and most successful Cleantech growth capital investors in the German-speaking area of Europe for the last 5 to 10 years. The three of us primarily bring two things to the table. One is very long and deep Cleantech knowledge, approximately 50 years of Cleantech experience in various industries. In addition to that, we've been involved, or we've been responsible for 7 successful IPOs in the past. Willy Mannheims and myself have been involved as C-level managers, as CEO or CFO in 3 IPOs. In the IT space, in the Cleantech space. Willy Mannheims and Helmut Vondran have successfully floated as supervisory board members 3 of the Ventis portfolio companies. Holger Schmitz mentioned them. And we floated ECT1, which is somewhat a unique product which was difficult to sell to continental European investors. It wasn't a difficult sell in the US. There is a very educated investor base, and they were very interested in the product we had to sell. So in total, we are convinced that we have a lot of experience, relevant experience for this transition phase a company goes through once it decides to shift its status from being a privately held company to a public company. And we will be there to assist the management, the company, to take this step and to make it a successful transition. Now let's move to the third agenda topic, and let me share with you what exactly we're looking for and how it ultimately works. We're called European Cleantech. We're looking for a business which has its head office in Europe, which is a cleantech business. We have a very broad definition of cleantech. As you can see here, we're basically looking at 4 areas which allow us to do almost everything. We're looking at classical energy substitution, which would be solar, wind, hydro, you name it. We're looking at energy or resource efficiency, which is everything from smart metering to waste management, recycling, batteries, storage, etc., etc. And we can also consider all kinds of suppliers, be it equipment, be it material, be it services. We could argue that a software business is a cleantech business if, for example, one of their various products is a suite to manage geothermal plants. So we are very flexible. We have a lot of opportunities to identify businesses which we can easily argue to be cleantech businesses. Oops, I'm sorry, I didn't want to go there right now. Wanted to highlight this area. There are some constraints or limitations in regard to the financial criteria as there are to the business criteria in us identifying the appropriate business. Typically, and I'm saying that on purpose, typically, based upon the assumption we're going to invest 100 to 115 million euros in one business in a minority stake, we're looking at an enterprise value of 250 million plus, 250 to a billion. Typically, that implies, based upon the valuation, it is a stable business. It is a business which has been around for quite some time. It is a business which probably has revenues of 100 million plus. In the end, everything is driven by the equity story. How attractive, how compelling is the equity story of the potential business target. So if there are companies which are smaller than those numbers that I've mentioned here, but if they have a really interesting equity story, we are also open to do those deals. Let me quickly talk about the process. Typically a 12 to 16-week process. We would sit down with the company, we would negotiate and agree upon a valuation, again, an advantage versus a conventional IPO. In a conventional IPO, you have the book building range. You don't know at what valuation your company will ultimately come out at. With us, you will negotiate and agree the value up front. Once that's done, we will go into a due diligence. At the same time, we will draft the SPA. And once that's done, we will call a general meeting. In that general meeting, we need a 50% majority, which is fairly simple to get. And then, within a logical second, you are a listed company. So it's a fast-track IPO. It's a basically no-risk IPO. It offers you all the advantages of being a listed company with the potential for further financing rounds. And keep in mind, something not mentioned on this slide, you, as the management, as the shareholder of the business, remain in the driver's seat. You don't have a private equity house in your back, which basically takes over. You remain in the driver's seat.
That was your last sentence.
That was my last sentence. Thank you very much.
Thank you very much. Those of you who have questions, raise their hands. Yes, we've got one.
Oh, we're listed on the Frankfurt Stock Exchange Prime Standard. The exchange can very easily be moved to other stock exchanges.
Other question in the room? We've got one here. Stand up, maybe introduce yourself.
Yeah, after the business combination, when you become a public company, we would require representation in the supervisory board because we will be the representatives of our current shareholders who will then be the free float. So we would require, to have seats in the supervisory board. We would move out after, I don't know, 2 to 3 years or so. But for that time, we would stay in the supervisory board.
I've got the last question. How many companies did you identify in Europe which have this profile?
We identified, and we only have a limited view because we don't know everyone, but we started out with a list which was significantly larger than 100. Now, you have to keep in mind that there are a lot of companies who tell you, oh, stock exchange is an evil thing, get lost, I don't want to know anything about it. But there is demand for something like this because it is a very fast-track IPO and it's a riskless IPO, and that's what companies are looking for.
Great. Thank you very much.
Thank you.